Hey folks, David Frost, MyStrategicForecast.com. You're here for another episode of Common Sense Market Analysis. Today is Thursday, July 31, 2014, and here it is. What do you know? You had the big down day. And this is a daily chart of the SPY, and just as I've been saying, I said when you break this low here from the 17th, or this line here, but preferably this low, okay, it would be game on. Well, guess what? Game on. Suit up. Put your seatbelt on. Tomorrow, barring a solid reversal day, you've entered the bear market. Okay? So here's what we're going to be looking for. There's going to be plenty of rallies along the way. There's going to be plenty of big down days. There's going to be bigger down days than you saw today. There's going to be up days that looks like the down day you saw today. Those are short covering rallies. They're the buy the dip rallies. They're all kinds of stuff. So you're going to have both flavors. So you have to pay attention when you're trading these markets. Okay? I think everything we have open for the members today was up. Everything on the board was up in our favor, meaning our shorts were good, they were down, and we have actually one long equity up on the board, and it was the only thing up today on the board, almost, anyway. So, stay with it, folks, because we're going to be able to navigate these markets, and we're going to put profitable trades on both on the upside and the downside. So what do you have? So the first probably solid level of support is going to be in this area here, and whether you bounce there for a couple of days or a couple of hours, we'll know it when we get there, and some of it depends on how we get there, right? So let's say over the next 2 to 3 days, let's say we move sideways like this, chop around, up, down, sideways for 2 or 3 days. Forget that, because we'll bust right through that if it forms a bearish pattern, right? And then we'll go down and we'll fill this gap here at about 190 and change. We'll call it here the high. We'll fill the gap at 190.48. So in my mind, that's probably the first real hot level of support. You got these this pivot high here, this pivot, this gap fill. So this is a big area. Call it 190. Just give or take, for argument's sake. We don't need to pinpoint the number. We need the direction right now. The number's not as important. Okay, we're going to be in stocks that are, $5, $6, $7, $8 in the money before you know it on the downside. So don't need to pinpoint the number. We'll know when the market's going to take a bounce, and we may cover. And a lot of times we cover half of our positions and let the rest ride, so we're guaranteed to lock in the profit. That's the way we play it. Proper money management is essential. It's the only way to make real money. All right, so back to the S&P. What's going to happen tomorrow? Well, you have some employment numbers in the morning, so the market's definitely going to react off of that. So don't be surprised if the government's out sharpening their pencil tonight on that number, and maybe you get some kind of a bounce rally early in the morning, some relief rally. If it's real strong, you wait and see what happens. If it's kind of on the weaker side with light volume, you can short into that rally. Okay, so that's basically what you have in the S&P. You had, game on. As soon as this level broke, right? As soon as this level at 195.43, as soon as that gave way, okay, you opened up right over it, and then as soon as it gave way, it was just down all day long. Here, look at the 10-minute chart. Here you go. Okay, we have opening, gap down, open. Okay, sideways for 20 or 30 minutes. And then the selling starts, and it was just relentless all day. Couple hours in the afternoon, you made some sideways consolidation. This is bearish, and then you finished on the lows. That's not a bullish signal when you finish on the lows. That's everybody throwing it up. So you'll hear all kinds of rumors coming out. You had the Argentinian debt problem. You'll hear they're going to pay off the debt. They're not going to pay off the debt. Don't listen to that nonsense. If they were going to pay off the debt, they wouldn't have been in default yesterday or today. So don't listen to that. Listen to what I'm telling you. I've been telling you that late July is a cyclical turn for the market. It's going to be a pivot. Now, I didn't have it on the day in the third week in July, for example, but guess what? What did we have? Over here was the 24th. Okay, here was the 16th. Okay, we go down, okay, whoops, we make a new high, it looks like I'm wrong, it looks like I'm wrong, a marginal new high, down, lower high, forget it. And that's what happens. So, I told you these cycles can extend for a couple of weeks. Go back and listen to the videos, watch the videos, any one you want from the last month, for example. I've been doing this, telling you the same thing for probably 6 weeks, that the market's going to turn in later part of July. Well, guess what? We're in the later part of July and the market turned. So here you go. So let's pay attention and make some money on the downside. Let's not second guess it. Let's just make some money doing it. All right, so just keep the rumors in mind. You're going to hear more rumors tomorrow. You're going to hear a hedge fund was liquidating, and that's why the market was down so much. They always say that whenever the market has a big down day. A big hedge fund was liquidating. Never do they know which one it was, and it's never talked about again after that day. So it's never true. It's just rumors. They try and prop the market up on television because everybody in this business, right, in the business of financial services, you have to be bullish. That's why you never hear bearish calls from the big firms. That's why you never hear bearish calls from anybody except independent analysts, because it doesn't pay to be bearish. Nobody likes to hear bearish news. If the market's going down, 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 do you think people watch TV, or at least watch CNBC or Bloomberg Financial News or Fox Financial or Business News? No. So they turn it off. They don't want to see the bad news. They don't want to see it. So guess what? If people aren't watching it, the numbers are down, right? The Nielsen ratings or the ratings are down. And if the ratings are down, they can't charge as much for advertising, so they make less money. So it's in their best interest to prop the market up. And that's why it's the pom-poms out, it's the bullishness that sells advertising, not the bearishness. People will watch for a couple days and then they say, I don't want to see this anymore. Get me out of here. I don't want to hear it. So you know how that goes. You don't want to hear bad news. That's human nature. So don't pay attention to the rumors. Just pay attention to the charts. Pay attention to what I'm teaching you and telling you, and you'll make money on both sides of the market. Let's jump over to gold. Okay, gold was down today, and that's okay because what have I been saying? I've been saying we want to buy gold in here, 122, 123. So we're getting close. Another down day or two, and we'll probably pick some gold up. Can it go lower? Of course it can go lower, but I think that this is a good area, and I think we're getting ripe for gold. I would say that within a week, I expect to see a turn in gold. So let's jump over and let's look at the GDX, and the GDX is still hovering above that inverse head and shoulder from the weekly chart, right? So as long as it's above that head and shoulder from the weekly chart, we're in good shape. Here, I'll draw that line in real quick, okay? It goes about here, okay? And there's your inverse head and shoulders on a weekly chart, right? So as long as we stay above this line, okay, we're looking for, maybe $10 to $13 on the upside in the price of GDX. Well, maybe 13 might be a little bit aggressive, but certainly $10. So that's what we're looking for there. We're looking for ultimately this number here, but we'll probably take some off before 37.38. So that's what I'm looking for in GDX. And interest rates, no, that's TLT. I want the 10-year interest rate ticked up a little bit today, but really it was much higher in the beginning of the day, and then it fell back down. And it fell back down because certain times people will run to treasuries and hide over there from the stock market, if you will. So that is going to impact the bond market from time to time. But the media wants you to believe that it's exactly correlated, and they couldn't figure out why rates were up but the market down. Well, that's because they trade independently. They're only correlated when they're correlated, but they're not correlated all the time. But look at this on the weekly basis, right? Look at this bullishness. This is a beautiful bullish pattern forming here. This thing is going to take off at some point, not necessarily right now. Later on, maybe later this year, this thing's going to take off, and we're going. We're first going to go to 3% on the 10-year, and then we're going. And let me just show you a little bit more. Okay, actually, you know what? I'll go to the monthly chart, and I'll show you where we're going. Okay, this is a great bullish, but look at this. You have the 20 period, the 20-month moving average going up, Okay, you're coming into the neckline of the 20 and the 50 period moving average after consolidating for months and months and months. Okay, this is a bullish pattern. Okay, you're going here, you're going up here. I mean, eventually you'll get up here, but that's a couple of years down the line. At least don't expect anything like that until sometime later, 2015, if at all, even that soon. But nevertheless, I mean, we're going to work our way right back up to 350. First 3 and then 350, and I see 350, maybe in early 2015 for sure. All right, let's do the USO. Because the USO, let's go back to the daily chart. Now the USO, okay, we were in a quick trade, the USO, and I didn't like it. It wasn't acting like I thought it was acting, and it was about a week and a half ago. And we reversed it. We got out of it real quick, and look what would have happened. We were long the USO. I didn't like it. And then we got out of it, and what happened was, here we are. We're going to come into this double bottom here, but don't buy this level. This is not the level that I anticipate issuing a trade alert, because I think we can get down here, maybe even lower, back down in this 35. We might even get down to about 34.5. And if we do, okay, that would be an area I'd be interested in picking up USO, but not right now. Forget the new highs I was talking about in oil. Forget the 110 for now. The trend is down, and that's the way we're going to play it right now. So we're going to look for a chart setup. We're going to look for a pattern, and then we'll play the pattern. But right now, let it fall. Let it find some support. Let it form a pattern, and then we'll go from there. The last thing I want to talk about tonight is the VIX. You had a tremendous move on the VIX today. Look at that. This is a huge move. This is fear in the market. This is essentially the volatility index is the amount of people that are buying, or institutions that are buying puts. Okay, that's what it is. Buy puts, send the VIX higher. I'm oversimplifying it, I know. However, that's what it is. Don't get wrapped up into them trying to tell you it's volatility. Volatility means the market moves up and down. I think it's a misnamed index, if you ask me, because what happens is if the VIX is down, the stock market's up. If the VIX is up, the stock market's down. So in my mind, it's just the inverse indicator. I don't know, whatever you want to call it, it doesn't make any difference, but this is fear in the market. This is people loading up on puts. Now, it's not necessarily puts to push the market down. It's also puts to protect long positions. So it's a lot of money managers, institutions, hedge funds that figure, well, I don't want to sell my big positions, because if this isn't the sell-off that everybody, or that it may be, or that at least you and I think it is, then I don't want to liquidate these positions. Therefore, I'll buy some protection, and some of the VIX rise is due to the put buying protection, protecting stocks like IBM, Exxon, high flyers like LinkedIn, like Amazon, like Google, like Apple, like Tesla, all that stuff. Okay, so it's all the high flyers that all the hedge funds owned. They're not dumping them yet. Sure, the stocks are going down, but if they were all dumping them, they'd be down a lot more than they've been down today. So that's what this is. But the tremendous move on the VIX. Make no mistake about it. The VIX is going to $20, $21. Maybe not tomorrow, maybe not Monday, but it's going to $20, $21 in a hurry, and then we'll see what happens from there. But I thought I'd make mention of that because it's interesting. Don't talk about it a lot. But when it's a big move like that, it's worth mentioning. So that's a wrap for tonight, folks. I'm David Frost, Common Sense Market Analysis. Be careful out there. Put your seatbelt on. And thanks for tuning in.